Welcome to the Risk Talks. My name is Yevgeny Ivansov. I'm the chairman of the European Risk Management Council. The COVID crisis has significantly changed the risk landscape and put enormous pressure on the risk management. While the crisis is far from over and we're not out of the woods yet, we need to look ahead and be ready to deal with the new challenges after the COVID crisis. How financial services will change and what should be the priorities for the risk management in the aftermath of the COVID-19 crisis. Today, I will talk to my guests who will help me to answer these and other important questions. Let me introduce my guests. Hanna Saraf, Group Chief Risk Officer at BankMed, who joined me from Beirut. Hello, Hanna.
Hi, Evgeny.
And Christian Pedersen, Managing Director at Accenture, who is based in Singapore. Hello, Christian.
Hi, Evgeny. Thank you.
Gentlemen, welcome to the Risk Talks, and thank you for your time and for agreeing to join me and share your insight today. Let me start to ask Christian first. The COVID crisis significantly accelerated digital transformation of the financial services. And at the same time, this process also elevated technology-related risks. How this can change the traditional risk landscape, and will it make technology-related risk more important than traditional credit and market risk, for example? Should technology risk become top priority for the chief risk officers today?
So I think the answer very much is yes to that question, Evgeny. And the way that I would think about this is that since the global financial crisis, we first of all had a heightening of financial risks, credit and liquidity, also market risk, and therefore lots of attention from the industry. We now have new technology, data, methodologies to manage those risks a lot better and to understand them better. So although I think, for instance, credit risk is a very significant risk and it'll remain even during COVID, we have now seen banks be better at handling them and also be better in terms of the backstop, which is capital requirement. So I think credit risk and financial risk are important, but I do think that technology risk is now the top risk for banks. There are many new technology risks that have come in. We've seen increase in cyber attacks. Also, there's the need to be able to capture significant increase in digitization within your own institution. I think CROs are not always fully equipped to have line of sight and transparency into those risks. And I think there actually have become what I would call an on-strategy risk technology. In the old days, we used to say operational risk were off-strategy surprises, if you will, and financial risk were on-strategy. You took financial risk to make a return. Now I think technology risks are becoming an on-strategy risk because banks need to invest in technology to be competitive and in order to sort of get the return, if you will. So I think technology risk now, in the broadest definition of the sentence, should be the number one risk for CROs.
Okay, thank you, Christian, and we will come back to technology risks later on. And I would like to ask Hanna now. Compared to the previous crisis, banks entered the COVID crisis with stronger capital and liquidity position, which definitely helped banks to sustain the first COVID shock last year. However, many risks are ahead, in particular, maybe credit risk will be driven by deterioration of asset quality, operational and cyber risk, Christian just mentioned, and also sovereign risk driven by increased level of public debt in many countries. In your opinion, what strategic capability a bank should develop to address the challenges stemmed from the current and the future potential crisis?
Okay, so thanks, Evgeny. So crises in general present opportunities for organizations to emerge stronger enabling them to build more effective and resilient business models across all stages of the crisis life cycle. So banks who invest in strategic steering capabilities can enjoy multiple advantages. There's the anticipation advantage, which is really the ability to predict risks before they materialize, allowing banks to have sufficient controls or strengthening existing controls to either minimize the risks from occurring or reducing the impact once they do occur. There's the impact advantage, which is essentially once you enter the crisis, you ensure that you have sufficient financial resources and operational capacity to withstand and absorb the shock without breaching the point of failure, which is capital impairment or liquidity cessation or experiencing catastrophic losses. And then finally, there's the recovery speed advantage, which is allowing you to recover quicker and faster than anyone else and adjust the necessary measures to allow you to return to the operating models and adapt to the new environment. So in each one of those advantages, risk management has a fundamental role to play to unlock the advantage or to enable it or even to drive it as a function. So for example, on the anticipation advantage side, we talk a lot about scenario planning and stress testing capabilities. It could be something as simple as a sensitivity tool that allows you to assess the impact of some sensitivities on the business model and balance sheet risks. So what if the economy contracts further in 2021? What if house price drops by 30% this year or next year? What if impairment costs continue to rise? And see the implication of those on the key performance indicators such as liquidity, solvency, profitability, and asset quality. Supplementing this with what I call a truly forward-looking risk monitoring system, which gives you the indicators you need to predict. Most of us look at indicators and metrics. They tend to be outcome metrics like NPL ratios and losses, but that's reactive. In a way, you will start reacting to the ratio once it happens. Supplementing this with forward-looking metrics such as the drivers of risks. So in real estate lending would be policy and underwriting criteria like loan to value. They are highly predictive of defaults or losses, or even market metrics, government bond yields or price, rent to price or property price. It gives you certain signals that are truly early warning. On the impact advantage, we all know about the capital adequacy assessment processes, liquidity adequacy assessment processes. We need to make sure they are calibrated to the right stress and shock to allow us to have the buffers you need as a bank to go through a crisis. And then lastly, the recovery speed advantage, the single most important tool I'd say a bank should have is a very well-rehearsed and calibrated recovery plan that has been identified early on, all the measures and the tools that you would use to allow you to recover quickly and a return to sustainable profitability. I suppose in summary, Evgeny, having strategic steering capabilities allows you as a bank to emerge, to respond to emerging risks and recover and adapt to changes in the business and economic environments.
Thank you, Hannah. I would like to come back to Christian and talk a little bit more about technology again. The COVID crisis has become a real-life test for the banking resilience, not only financial resilience, but also operational resilience. And do you see a trend in those being increasingly integrated in banks under the broader resilience banner?
So this is a great question, and it's one we are addressing with a number of our clients at the moment. There's actually three sets of resiliency out there: financial, operational, and then we break out technical resilience. And we do that because they have three different owners. So the financial resiliency ultimately sits with the CFO and the balance sheet, that we have a strong balance sheet. Operational resiliency, the first person you look for is the chief operating officer, making sure that the operations are sound. And Hannah just spoke great about, the sort of plans that you need to have in place to absorb shocks. And if you've got the technical resiliency, you digitize, you have many more technical risks such as cyber risk, security attacks, etc. So there's a resiliency plan for each of those three, and they do overlap. Each business draws upon the balance sheet, draws upon operations, and draws upon technology increasingly. So they are integrated as well. So the challenge to coordinate that from a second line of defense perspective for the CRO is probably greater than it's been before. And the sort of CRO needs to think about, whereas squaring up against the front office of the business, the risk and return is quite clear, front line, second line. Each of the three enterprise functions, finance, technology, and operations, is obviously also a first line of defense function in this context. So I think for the CRO to really define their role and what they need to be checking when resiliency tests are already being run within finance, within technology, and within operations is quite important. And we are indeed seeing some institutions choosing to collaborate a lot closer bilaterally with those functions. You blur the lines a little bit, but you define a line 1.5. The CISO, what the good original example of that. But there are also banks who have chosen to try and think about setting up a resiliency unit that can bring together resiliency tests across financial, operational, and technical. Now, that often then raises the question of how is that different from a risk function, and what is the true role of resiliency versus risk? So there's no straight answer to how this is going to happen. What I will say, it will happen in the industry. You will see more integrated resiliency, and the core challenge is really how the banks choose to implement that in a very transparent way. So the answer is yes, it's work in progress, but leading banks are looking at integrating those three types of approaches.
Thank you, Christian. Very interesting. And I would like to expand a little bit and to talk about the banking business model as a whole. And maybe, Hanna, it's a question for you. The challenges created by the COVID-19 crisis has already seriously affected banks. And if we look at further, we see that the super low interest rate environment has squeezed interest margin and put additional pressure on the bank's profitability and return on equity. What is, in your view, on the sustainability of the bank's business model post-COVID crisis and the role of risk management in addressing those challenges?
Yeah, that's a very topical question. I suppose if you go back to 2008, 2009, post the financial crisis, Evgeny, you see that most of the effort was on strengthening banks' capital ratio, capital adequacy, numerous initiatives, be it the Basel III Accord, the asset quality reviews, stress tests, all of that was meant to improve the quality and quantity of equity capital that banks should hold. And we've seen this over the last 10 years. So, CET1 ratio improving from 9% in December 2009 to 15.5% December last year. So banks are basically solvent and adequately capitalized. But when you look at the profitability side, the picture is slightly different. You see that the return on equity has been decreasing and deteriorating over the last 10 years, averaging something around 5-6% in Europe across the most significant banks. And the trend has been persistent. When you look forward, the expectation that there will be more impact, you mentioned COVID-19 in terms of asset quality and so on. So there will be more pressure on return on equity in terms of its evolution. And that has a direct correlation with how the investors perceive banks. When you look at the price to book ratios today, all major European banks are trading at a significant discount to their book value, 40-50% discount, which puts them as a target essentially to any merger and acquisition activity. We've seen some of that happening last year, particularly in Italy and Spain. Just as a means for some banks to boost their operational capacity and geographic diversification and so on. So you asked me the role of risk management function. For me, if you decompose return on equity, basically risk management has a role in each one of the components on the numerator side of the ratio and the denominator side of the ratio. On the numerator side, looking at the revenue and costs. On the revenue, by deploying sophisticated pricing strategies, be it on the asset side, so risk-based pricing, for example, is a key strategic capability tool you mentioned earlier. On the liability side, on deposit pricing, setting interest rates based on the long-term relationship with the customer and the elasticities they have to interest rate changes is a capability underpinned and enabled by investment in technologies. So technology, it helps you to get to this level of detailed segmentation of your customer base. And I sometimes refer to it as a customer of or segment of one, to really understand the behavior of our customers and to be able to devise the appropriate plan and strategy for them, be it on the, again, loan or lending side or deposit side. That has demonstrated a huge benefit when it comes to revenue improvement. On the cost side, there's operating cost element by automating most of the process and risk management. So credit risk, for example, in terms of the credit management process and the decisioning aspect, the decisioning analytics, embedding it and automating it up to a certain threshold, it can be all automated, particularly in retail and to a certain level in SME portfolios. Applying machine learning techniques to help you use some behavioral data of customers and maybe some unstructured data to better predict default and therefore reduce costs, or even applying text mining techniques to detect money laundering activities, or to deploy some pattern recognition techniques in machine learning to detect fraud. All of these capabilities help you reduce costs and ultimately losses. The second element of the cost is the cost of risk, otherwise known as the expected credit loss or impairment charge. Again, having a good understanding of the drivers of ECL and the volatility of these numbers helped hugely in smoothing the volatility of earnings as well as the return on equity. When you move to the denominator side of the ROE ratio, the equity side in itself is driven by two drivers. You have the risk-weighted assets element, which seen numerous initiatives of the last 10 years by regulators trying to ensure comparability and consistency and reducing the variability of RWA across banks. The last one, the finalized Basel III Accord, otherwise known as the Basel IV, yet to be implemented, has been delayed by 1 year to 2023. It will have some implications for banks in terms of risk-weighted assets inflation, and it's very important for banks to understand the requirements and the changes and its impact on the various portfolios you have. The second element of the equity side is the target capital ratio for capital planning. Today, most banks are revising, and some of them have declared recently their ambition. They're revising their ambition in terms of CET1 ratio to target. That's because the CET1 ratio in itself that you target is directly linked to the key material risks that are inherent to the bank's business, be it the Pillar 1 or Pillar 2 risk from a Basel terminology perspective, but also the buffer that you have to hold for stress testing. So once you have a robust assessment of the risk profile, be it on the Pillar 1 side and the Pillar 2 side, as well as the robust stress testing capabilities, you will be able to demonstrate to the regulator and defend your case for what is the target CET1 ratio as a bank you need to aim for. So I'll end up by saying that devising a sustainable business models and bringing profitability back to attractive levels, be it above the cost of equity level, is going to be a challenge in the context of the current market environment and the pressure on interest income. However, there are still, I suppose, performance improvement opportunities that can be generated from risk management initiatives in particular that helps to a certain extent banks improve their revenue or reduce costs further or optimize the allocation of the scarce equity they have.
Thank you, Hannah. Yeah, indeed, that's a challenging task, but it should be solved. I would like to stay on this strategic topic and to ask Christian. If we look back, after the global financial crisis, we saw the process of integration of risk management in strategic decision making, for example, via risk appetite and other risk-related constraints. Do you expect a similar trend post-COVID crisis? And if so, with the lessons learned during the crisis, how should risk management influence and inform strategic decision-making going forward?
So thank you very much, Evgeny. That's a great question. And it's something that I think has two facets to it. One is that clearly, as Hannah pointed out, the global financial crisis led to a little bit of soul searching around needing to understand the balance sheet dynamics better in order to defend and also to produce and be proactive around planning. So we definitely saw risk-adjusted profitability get a reboot, more focus on capital and liquidity in planning. And that is partly why we were at where we are now. We have learned the lesson around those financial risks. The regulators also took it to heart. Things like CCAR in the States and so on, where banks were really forced to go very aggressively at stress testing from a risk perspective and using it in planning. And of course, more importantly, I think it set up that vehicle whereby risk considerations can be considered in planning. So I think we actually have done well, and I think those vehicles need to stay open. Now it's a question of recalibrating the risk appetite statements, given COVID, again, financial risk, but also with new strategic risk considerations. So in some markets, you have got new entrants who are digital banks. You have banks themselves digitizing. Are we able to calculate the adequate risk-adjusted return of an institution like that, or a division like that, if, as we argued before, tech risks are becoming as important as credit risks? How do we size them? How do we compare them? So I think that's going to be a very interesting period where you don't just look at the business case for building something out of expanding in a product area from the perspective of risk-adjusted return based on financial risks, but you truly understand whether that leaves you more exposed to security risk or business continuity challenges, etc., and how you get those integrated into the strategic plan. Those, I think, are harder to formalize in a quantitative manner. And I think, therefore, there's going to be a lot more focus on the risk function being able to understand and clarify those sorts of more qualitative considerations in the plan. I think that'll be the big change that we will see. But fundamentally, banks are not doing badly at this at the moment in terms of the overall risk profile. It's just that the profile itself and the nature of the business that's being assessed will actually change going forward.
Thank you, Christian. And I would like to ask the last question, and this question will be for Hannah. When we talk about Chief Risk Officer's priorities, we can't ignore an elephant in the room. I mean, climate change risk. The COVID pandemic signified the importance of having the proactive approach to dealing with the existential risk like that. How can bank incorporate holistically climate risk in the risk management frameworks?
Yeah, I think it's very topical and relevant at the moment, Evgeny. So from a climate risk perspective, if you think about it, similar to COVID-19, it is a standalone risk and it's an amplifier to existing risks. And therefore, it's a source of systemic risk and it should be treated as such for banks. Now, climate risk, whether it's physical risk or transition risk, it will have a transmission channel to banking through lending and asset holding, be it on the asset side, in terms of adjustments to pricing and asset values or impairment costs, but also operational risk in terms of disruptions of businesses, value chains, and the costs associated with that, as well as liquidity risk in terms of unexpected outflows it potentially experienced as part of those risks and the impact it has on the high quality liquid assets a bank should hold. So definitely it should be part of the risk register of any CRO, and the way you treat it is the same way you treat any other risk categories. It has to go through your risk management framework and process underpinned by a robust governance structure. So therefore it should have its own risk appetite framework. It should be set. It should be cascaded down to policies and procedures. You may have a differentiated policies or criteria for those customers that have demonstrated certain sustainability targets or sustainability or progress on achieving certain sustainability targets. On the identification and assessment side, you should make sure it's part of your risk register. You should have assessed it top down, bottom up by engaging with your customers, understand their plans, transition to low carbon economy. And on the measurement side, by deploying what is currently emerging as a scenario planning tools to help you come up with the various impact of the climate transitions. So it could be the trajectory of carbon prices or emissions over time, the global temperature changes and the impact on the economy, and the implications of this would have on your portfolio, be it on the asset side or liability side as a bank. And then finally, embedding it into your decision-making process. So through start with the planning side, when you set the limit and risk appetite, the calibration of the asset mix of the portfolio, but also on the origination side. So when you rate the customer, when you price the loans, and when you look at the collateral valuation, all of these have to have climate risk factors embedded into those decisions. And then ultimately, if deemed material, it has to be part of your capital adequacy assessment and liquidity assessment processes. So I suppose I'll end up by saying, with risks come opportunities. There's substantial investment in renewable technologies, renewable energies and energy efficiencies and efficient mobility. And this presents opportunities for banks. We've seen some of this happening recently with the issuance of green bonds and the green mortgage lending, and then banks setting dedicated budgets and funding for clean economy through funding infrastructure projects and green businesses and so on. So definitely climate risk, it is one of the top risks that it will remain there for a good while.
Yeah, I agree with you, Hannah. Gentlemen, it was a great pleasure to talk to you today. Many thanks for joining me and sharing your great insight. Thank you very much.
Thank you, Evgeny.